Assalamualaikum, Nachtjalan. Let's get ready to rumble. And welcome to the second episode of the Six Figure Discussions.
Walaikum assalam, Nachtjalan. Don. We are ready to rumble. That's right.
That was not very convincing.
I was trying to think of something witty to say, but my mind just went blank, man. So, yeah,
That's good enough.
this is our second episode. How you been, bro?
I've been good. The week was a busy one,
Mhm.
but I think the Memorial Day weekend, having some extra days to relax is good. We were supposed to be off today, but I still decided to go out to the office and get some work done. Yeah, I feel a little uncomfortable on the days before work. It's like get the Sunday scaries.
Oh, yeah.
The best way to get rid of the Sunday scaries is usually just by going and actually doing it.
Were you procrastinating over the weekend?
Not necessarily procrastinating. It's just I'd say whenever there's a start to a new week, I think Friday, Saturday, you're usually relaxed. You don't really think about work.
Mhm.
And when Sunday comes around, you actually start anticipating what's going to happen on Monday, what's going to be in the week ahead. You start mentally preparing yourself, and that gives you a bit of an anxiety. It's just like, oh man, I got that done, I got to get this done. But then this weekend, because Monday was not a work day, Sunday was the fun day. And Monday is the actual day when you start thinking.
Yeah. Do you have that thing when the weekend starts, you downplay your work responsibilities? Like, you underestimate what you have to do until, like, late Sunday. Then you realize that
Yes.
there's a lot of stuff that you need to do.
Yes. And then you start freaking out. You're like, oh. But then usually on Monday it turns out fine. The week starts, as long as you have a plan, get stuff done. And I think the great thing about my current work environment is I work in a small team, a really small team. So there's definitely a lot of accountability, but there's also a great deal of understanding. There's a lot of work and not a lot of people.
Mhm.
And coworkers, my colleagues are mindful of it. They know that I have a lot on my plate, so they try to manage the deadlines, and they try to be respectful
Right,
of my
right.
time. And I try to manage expectations as well. Like, tell them, hey, I actually have this, and this on my plate, so if I'm a little late on this, please apologies in advance.
Nah, you're good. Do you like the communication aspect of your current work? Like the way you guys communicate regarding responsibilities and potential delays?
Funny enough, that's a really good question, because I was actually thinking about it the other day. So I was talking to a couple of friends of ours, the Ozzy and Max. They're both in the IT industry. They're software developers, and I got curious about cussing in the workplace, whether swearing is as accepted in the IT industry as it sometimes is in the financial services industry. I wouldn't say that people are just like cussing left and right in investment management or finance in general, but I'd say it's not unheard of to people to just cuss in a work. So let's say if you have a formal meeting with somebody, it's the first time you're actually meeting them, chances are they're probably not going to say anything on English. But on a day-to-day, the words like shit, fuck, just regular swear words. They're not unusual. People just drop f-bombs here and there, and it's fine.
Mm-hmm.
Which is why I got curious. I'm like, man, is this just like a finance thing where people just don't care and they're able to just express themselves, or is this across the board and it's more of an American culture? It's acceptable in the American work environment to just swear. Does your PM ever just like drop an f-bomb in the middle of a stand-up?
That hasn't happened to me. I haven't heard PMs cuss at all, but I have heard like a test lead, right, or dev lead slip up with like shit, but that's about it. Yeah, I think even in movies, right, they portray finance industry people as those that are very generous with cuss words, you know.
The gold days of the Wall Street.
Yeah. Now that you brought up OZ and Max, let's give a shout out to uh, uh, the shawarma place, that the food truck that opened recently, because I saw that on OZ's story. Man, that looked amazing.
Yeah, it's really great to see the Kurdish American community here thrive in businesses. And we went out there. The shawarma was actually really good.
Yeah.
Gave me a bit of a nostalgic feel. It's like as if I'm back in Bishkek, and it's shawarma is shawarma, and I feel like you eat a great deal of just like Middle Eastern style shawarma, but then the shawarma that we ate there. So the name of the food truck is Navat. It's NAVAT. They should be paying us for this, by the way. But yeah, so the shawarma itself felt like it was made Bishkek style. It's like a really juicy shawarma with flavor. It's not typical of like just like Middle Eastern trucks that you see here and there.
Mm-hmm.
It actually felt like I was back in Bishkek and I stopped by like a shawarma place. And I told them right away, hey, listen, like this is giving me major nostalgia. Like I haven't been back in 10 years. And this feels like I'm back. This definitely takes me back. And the Six Figure Discussions is brought to you by Navat Food Truck. Navat, please pay us for this.
Now there's another reason for us to come back to California, man. Try the shawarma.
Man. Yeah.
Okay, let's jump into the second episode. What do we have on the menu today?
Today, I'll talk about the financial markets.
Regarding the financial markets and crypto specifically, are you up like a lot on Luna now?
No, wait, is it up? Goodness. Wait, I gotta check my Luna, man. I gotta check.
I feel like the moment you check it, you dip from the podcast, man. Peace out, guys.
Oh man, did I miss out? Wait, goddamn, man. I think I might have missed out on it.
How? I thought you bought it at like super low prices.
No, I bought it. It's just I bought it and it went to zero, and I kind of assumed that that's it, like game over, and I'm done basically. But if it went back up, then I have to check. Ratan, I have no idea. I have no idea. I know, all I know is that Aiden, so my cousin Aiden, has been checking it every day, and I think he has like 1 million Luna right now.
Mm-hmm.
So he's convinced that it's gonna go back up to 100. It's gonna be back at the 100 level.
Mm-hmm.
And I'm like, I don't know, man. But it would be good. When it goes up to 100, don't forget about your boy.
I think they did something like a Luna and then Luna Classic. And now, like, even if you convert your old Lunas, well, if you convert your, like, basically people who held Lunas before the drop are now holding Luna Classic. And now that you have to migrate over to the, like, official Luna 2.0 or something, I guess, I think whatever Lunas you hold, it's kind of, like, priced in at a super low rate or something like this. It's kind of the same thing that happened with Ethereum in like 2017, 16. Well, not to the same extent with the drop, but well, Ethereum got hacked, and original Ethereum code is the Ethereum Classic. Then the Ethereum came out from that. But
What's going to be the new Ethereum?
no, that's the current. That's the one that we have, bro.
Yeah, but I mean, as in, is there going to be an Ethereum like 3.0? If so, when is that going to
I have
be?
no idea. They are still delaying their, what's that? They call this what, Ethereum merge or something, which was supposed to be the introduction of the not smart contracts, the transitioning from mining to staking. I delayed again. I think since 2014, the day was announced. Since then, it's been like always delayed, and I don't know why people still believe in it. It's a lost hope, man.
That makes me wonder. So when you're a guy like Vitalik Buterin and you are the CEO of a massive token in this case, or even a company,
Mm-hmm.
and you come from an engineering background, you actually coded your entire life. That's how you made your living. When you get to that CEO level, and you got so much other stuff going on, you got your CEO responsibilities. Do you think you continue coding? Like, let's say Mark Zuckerberg. Does Mark Zuckerberg code?
I think it varies from person to person, but if we were to talk about Zuckerberg, I think he still does code. But if we compare, for example, and also think Vitalik also still codes. But if we also look at the Duquan guy, the Luna CEO, right? I'm pretty sure he probably coded until the Luna part, and then probably stopped because of all the investor money he got, all the attention he got, and kind of slid away. Because you could tell just by looking at people like Zuckerberg and Vitalik Buterin, right, that they are really passionate about it. To them, it's not like a chore to code. So in that sense, I think it's understandable that Ethereum is taking this long because, well, the network is way too congested. Fees are too high. There are way too many dApps on the blockchain. But to be devil's advocate, they kind of had a really quiet time from 2014 and 16 to finish the transition, in which they haven't. So we don't really know who to blame here.
I guess I don't even understand Ethereum 2.0 enough.
The main talk has been this 2.0 merge, which they've been rebranding to something else for like past 2 years at this point. If talking about the 2.0, then it's just transitioning from mining to staking. I think there was a previous upgrade last year that they did that reduced the fees, which actually hasn't addressed the issue, because what ends up happening is it's like the more Ethereum burns its tokens, the higher fees actually get. So it actually counters whatever they upgraded the network with. So
One thing, so I was at a conference down in Miami, and I was talking to a hedge fund that specifically trades cryptocurrencies. And it was a quantitative hedge fund that was essentially trying to take advantage of different price discrepancies within the crypto markets. And essentially, their thesis was that crypto markets are still very early stage. As a result, there are a lot of inefficiencies. Really big portion of this retail, and therefore quants like them are able to take advantage of inefficiencies within the market. But I don't think they had any fundamental views on crypto in general. And the way, so literally the first sentence, the way they broke down crypto to me, so the gentleman that was the portfolio manager that sat in front of me, he said that essentially you should treat every cryptocurrency as a seed stage or early stage venture capital investment. Because that's what they are. You're essentially backing very, very early stage or seed stage companies and it's kind of like 50-50. A lot of them fail, a lot of them take off, and it's really hard to tell which one's going to be which. And that's what firms in the venture capital firms in Silicon Valley do. They don't really, nobody has the recipe to know what's going to be the next Uber, what's going to be the next Facebook. You just back a bunch of really talented founder teams and you hope that one of them takes off. And that's going to be enough to pay for the rest of them. And I think fundamental approach to crypto is somewhat similar in that you just back a bunch of them and then you hope that one of them will take off and that will pay enough for the rest of them. And if you think about the public markets, so the equities markets, usually, with the exception of the last 10 years, everything has been volatile in the last 10 years. But usually, the smaller the stocks, the more volatile they tend to be over time because they're usually less liquid. And it's just they're less stable compared to, let's say, if you take a mid-range technological company versus Google, you have a lot more certainty in that Google will exist 10 years from now compared to that small technological company. More likely to go bankrupt, it's more likely to lose profits, stuff like that. But then the smaller you keep going in this essentially pyramid of the sizes of different companies, the smallest is obviously early stage, seed stage startups. And those, if they were publicly traded, they would be the most volatile of them all. And the reason why they're not is because they're not publicly traded. All these startups at the early stage and seed stage, they're not publicly traded. It's all private, held by venture capital firms that have different institutional investors as their investors. So like endowments, foundations, pensions, stuff like that. And but now crypto is essentially introducing access. It's like a tangential but still access to early stage and seed stage ventures. But it's highly liquid and it's publicly traded. And that's why you see all this volatility. If they were trading on the public markets, they'd be just as volatile. They'd be freaking trading like crazy.
Yeah, add to that the fact that the space is unregulated, that just opens the door for all types of traders to manipulate the market.
Got it. Yeah. Can we go into a little tangent and talk about a purely hypothetical case?
Go ahead.
So if two people with a podcast wanted to start a coin and purely for profiteering reasons, no fundamental views, nothing built up, just let's build a Luna, take it to the moon, and then take the money. How would they go about it?
Okay, let's also preface this by saying that none of what we talk about is a financial advice, life advice.
That's a good disclaimer.
Yeah, we're just two idiots talk about things like everyday people have in their minds, everyday people of our age. So we're just bouncing off ideas. So none of it is a statement or a claim or any sort of investing advice. So we have no clue, basically. We're just as clueless as everybody else. Yeah.
SEC,
now back to
don't come after us.
Back to the thing. Well, I don't really know the details, like what you would need to do and the steps you need to take to create your own coin. But if you see so many different scam coins launched left and right, then it's probably relatively simple to do it than, say, to do something similar in the stock market, right? And given the fact that a bunch of codes for cryptos are decentralized and public, like open to public through GitHub and other repositories, it's easy for someone with malicious intent to copy the code, add a couple tweaks, create his own project and name it whatever, paste that code there, modify the tokenomics, and if that individual has some money, he can also pay all these Twitter crypto gurus, influencers, YouTubers who are just so unethical. Like they are willing to take the money to promote whatever coin is pushed by whoever. They don't really care about the everyday people who end up losing money investing in these coins. So if you are that individual who has created his own coin, you go to these influencers, you pay them, they promote your coin, and before anything happens, everyone before the public gets on board, so that by the time public gets on board, you dump on them. So just typical pump and dump, basically. But it's a lot easier to accomplish. You remember there was the story a year ago about the Netflix, the Korean TV show that was super famous. What was the name?
Squid Game.
Squid Game. You remember the coin, Squid Game coin? Like no one still knows who were the founders of that coin. They just launched it. There was a whole bunch of hype. A lot of those crypto influencers promoted that coin, and boom, it disappeared and went to zero. You don't know who it was. You don't know how they did it. They just gone. And that's also another risk with cryptos, is that you really have to not just do your due diligence, but you also need to watch who you're listening to and who is promoting what and why are they promoting it. Like, do they really believe in a coin, or do they have a history of promoting just all bunch of coins? If that is the case, then you should just stay away from whatever coin these influencers promote. But yeah, back to your thing, that's how you would do it.
So what you're telling the audience is that there is no proof that you and I launched the Squid coin, but there's also no proof that we didn't launch the Squid coin.
Based off what we know, yeah.
Yeah, so it could be us, but it could also not be us, and you can't really prove either.
Correct. Yeah.
That's the tough thing. But so to make this, I guess, turn this into a more productive direction. If for future investors or for current investors out there, how do they avoid blunders like Luna? And what are some of the lessons that we learned from Luna and the Squid coin for that matter?
Well, I think it goes back to the fundamental investing advices, right? It's set by people years ago. If it sounds too good to be true, then it probably is too good to be true. And Luna had this project, right? Anchor Protocol, I think, which was paying you 20% API. Turns out it was a pyramid scheme. So a bunch of people used Anchor Protocol, and the thing went south eventually. That's one lesson. If it sounds too good to be true, then you should probably stay away from it. Second is, I think it's also critical that you pay attention to the founder in terms of how he communicates with the audience. For example, if we take Do Kwon and Charles Hoskinson, right? Which Do Kwon is the founder of Luna, Charles is the founder of Cardano. People give Charles a lot of backlash, like a lot of criticism for the fact that he just communicates with his audience with any upcoming updates, anything that's on the way. He always keeps the public in the know, and people give him criticism for that. Oh, you talk too much. There's a lot of talking and no action. But in reality, he's being genuine. He's been open about it. But you don't see him go on rant on Twitter and bash a regular Twitter guy for saying that, say, Cardano sucks. He's not gonna go and say, oh well, good luck staying poor, right? Whereas this Do Kwon guy, like, there were definitely telltale signs. I'm pretty sure some people paid attention to it, but one of the signs was that he got way too arrogant and got way too ahead of himself. I'm pretty sure you've seen those tweets too, like that they've emerged, where how he would talk down on people on Twitter, like, oh, good luck staying poor. Oh, this is Luna. We're going after the stable coin. We're going after dollar, whatever else he was saying. And yeah, by talking to his audience this way, he kind of created a cult where you could not penetrate that cult with any constructive criticism because everyone was just so put in this like echo chamber of yeah, Luna is the thing, Luna is this, Luna is that, that now it came crashing down. Yeah, but to go back to the point, just let's make it clear that Cardano and Luna are not comparable. They're not the same, and they will definitely not perform the same. One is legit, one turned out to not be legit, so we'll leave it at that. At least so far, we haven't seen Charles pull off anything like this, and he's been in this he was one of the early investors in Bitcoin, like since 2011 or something. So
I like how smoothly this turned from a lesson on how to avoid the likes of Luna to a short marketing pitch for Cardano. Shout out Cardano. Opinions, no financial advice.
Yeah, I think Cardano has one of the highest chances of succeeding over long term. Well, we're yet to see how the SEC will react to them doing the staking and people in US getting those rewards. We'll see. But back to the thing. So that's the second lesson. Pay attention to the founder of the project, right? So that you can catch those red flags right away as things progress. Third thing, one of the things that is an advantage of crypto industry and at the same time a disadvantage is the fact that the space moves way too fast, right? There's always new concepts, new ideas, new everything about the way it gets transacted on the blockchain. And I feel like a lot of retail investors have become jacks of all trades, but masters of none, in the sense that you try to understand every single project that launches, and you tell yourself that you understand it, but in reality you don't, because there's so many. Say you hold 50 projects, right, and each of them is different. Yes, you might know on a high level what they do, but you don't know them in detail. And that is a good thing if, say, they end up like 50% of them does well, but if most of them don't, then you kind of are in a really bad situation. So I think specification over generalization is an advantage in crypto, in that you should just focus on 3 or 5 projects, like really do your thorough research and stick with them. And if a new project comes up, say in next Luna, you just kind of have it on the lookout. And if it's not in the same field as your other coins are, then you should just not invest in it, I think.
Stay disciplined and I guess stay within the fields that you understand.
Right, unless you're willing to put in the work to expand your understanding of other new emerging ideas in the crypto.
And for people who, I guess, who are new to this and who perhaps don't have as much of a technical background to be able to develop expertise in these different fields, how can they at least get up to speed to develop at least some basic knowledge of different types of fields and actually be able to have an educated opinion on the coins that they're holding? So, because I think you, in one of our offline conversations, you once mentioned that reading white papers is good, but it's also really tough.
Yes.
Because there's a lot of complex math involved, and it's really hard to chew through all of this information.
Yeah, I don't think going with the white paper is a way to go for someone who is new to the space, unless you have a history with coding or you understand cryptography in general, right? Overall, I don't think it's a good idea to start with that, because it will discourage you, it will overwhelm you, and you will kind of think, oh, well, it's not for me, right? But in reality, you could, a simple thing as watching a 3-4 minute YouTube video, animated YouTube video, is like will suffice to give you a general understanding of what the crypto is about. And I think starting with Bitcoin is optimal way to go about it, because once you understand Bitcoin on a high level, then you understand Ethereum on a high level too. And then from that, what you end up doing, you end up comparing the two. And then slowly you start to, oh, okay, so then there's this part, there's Cardano, oh, there's Solana, oh, let me look into these. Over time, you kind of develop what you are into, and based on that, you invest in the coins that you believe have potential. I think the best way to go about it is just watch super dumbed down YouTube videos that explain the concepts through animation. There are a lot of those videos on YouTube these days. I would probably avoid listening to big influencers or YouTubers talk about a crypto, because like they also leave out a lot of details that are extremely important for you to understand, as they are just more concerned about the financial aspect of it, or the returns that you could get, right? So
yeah, I mean, at the end of the day, they're glorified marketing people.
Yeah.
It's in the name right there, influencers. So They're there to influence you. They're not there to give you an educated view so that you could make an educated decision. But going back to the whole markets thing, obviously markets have not been good to crypto as of late. I think 2022 so far has been a tough year. How does it compare to the bear markets that you have seen prior? I mean, you've been in this space for a while at this point. In crypto space, you kind of age in dog years, so you're basically a crypto dinosaur at this point. So, how do you compare the bear market that we've seen now to the bear markets that we've seen before? Is it the worst, or is it not even close?
It's interesting with the way things are going in crypto right now, because it's kind of in the league of its own in terms of like if you compare this market with the past ones. And I've been in the space since late 2017, so I probably don't have all the data. But from what I've seen in 2018, the bleed was slow and it was vicious when it would happen, right? You can even look at the charts. You could see there were a lot of red candles on the daily since the Bitcoin peaked in like 2000, like I think mid-December 2017. You could see in the charts like the volume is just all red since then. But what you see today is yeah, it's brutal, but I don't really think we are in a bear market. I think we're just in the stage where the space is getting cleaned from all the leverage traders, because one of the downsides of crypto is like you can leverage 100x, right? And it could play either way. It could go up or it could go down, and that's where the crazy volatility also comes from. So, but when the altcoin bull market started in 2018, it also happened right around the time when Fed started to increase rates, which we're in the same situation where the Fed is increasing the rates, but we haven't seen anything spike, right? There are a lot of uncertainties in this market than there were in the last one. So we really just don't know how it will play out. I think we're not in a bear market, but who knows? What if, say, something crazy happens with either war in Ukraine or potential threat of China invading Taiwan, right? That could just put the entire space to ruins. In that case, then, well, we're done. Even if you look at the volume, the daily candles for the current market, you don't see that much of a red. You just see a lot of wicks, which basically indicates that traders sell and then people pick them up at those lowest prices, thus increasing the volume and actually printing the green. Let's consider this market a bear market too. I don't think these two bear markets are comparable in this sense.
Makes sense.
Yeah.
Another thing that probably makes it a bit different this time around is just the increasing institutional adoption. I don't know how much institutional adoption there was around 2018.
There was none.
Yeah, there's a considerable amount. I think there's statistics as of last year, before this whole drawdown, about 52% of institutional investors in the United States held crypto, specifically Bitcoin, I think. And that's according to Fidelity's digital assets division, which was, I think, a newly launched division within Fidelity. So a large asset management shop has this kind of crypto department within it now. So institutional investors, obviously bigger flows, that means bigger inflows, bigger outflows, and I think the crypto market is very flow driven. Flows definitely affect asset prices, and that's universal across asset classes. One thing, Kanye, I will let you finish. But one thing I was really mind blown by when I was reading through the Fidelity digital assets kind of primer on the crypto industry and the institutional investors. within the crypto is that there is a current adoption trend between the different types of institutional investors and within different geographies. So let me share my screen, and then we can edit that in within the video. But one thing, hold on, let me try to.
While you look it up, can I add a point?
Please.
Okay. Another thing I wanted to mention is, like you said, right, there's a lot of institutional adoption. The extreme volatility that we see today is actually coming from leverage trading, right? And I'm pretty sure you know this too, but you remember all this time SEC has been rejecting the Bitcoin ETFs, but they've been approving Bitcoin leverage ETFs. And it's kind of no surprise the volatility that we have today. I think probably the moment this thing was announced and the moment this was approved, a lot of people bet that, oh, well, yeah, now that the SEC approved the Bitcoin leverage ETF, now the space is going to go to the moon and everybody place their positions only to get wrecked by whoever is playing this market. And I think it will keep going until they kind of get rid of most of the leverage.
Yeah, the crypto asset class is as risky as it gets, as is already, and adding additional risk on top of that in the form of leverage is just
I know
degeneracy. But hey, to each their own.
Yeah.
If you want to stack up your garage with a bunch of Lambos, like, all the power to you. Hope it works out.
You first get the garage.
Don't end up living in a garage.
Yeah. Yeah.
So current adoption and channels to exposure. This is the chart that I found really interesting. So the type of institutional investors and the adoption, I think, all makes sense. Look at the adoption curve. Just focusing on the U.S. Traditional hedge funds, endowments, and foundations. So about 13% of adoption. Still very early in the stages, but endowments and foundations traditionally have been, I think, innovative compared to other institutional investor types. So I think that makes a lot of sense. But then if you look at the family offices, you see a lot more adoption among the family offices and financial advisors. So that's the way family offices are set up, is just have like a really wealthy individual who has either millions or billions in their net worth. And instead of being like Elon Musk, where a significant portion of your net worth is concentrated within a couple of companies, you essentially set up a family office and you have a diversified portfolio of different stocks, maybe some bonds, real estate, hedge funds, venture capital, other types of investments. That's what I think Bill Gates did. So Bill Gates has a family office set up, and I'm sure a lot of wealthy families in the United States and globally have these family offices set up. And then financial advisors is essentially the same thing, except it's for smaller scale. So say if you have 10 million or $1 million in your liquid worth, then that's what you usually invest in. And then I think if you're an individual, you probably have a lot more risk tolerance, because at the end of the day, it's your own money. So you're able to allocate it to different risky investments. But then if you're an endowment or a foundation, you have an investment committee that you're responsible to, that you're supposed to provide reports to and actually answer their questions. If you're investing in something as risky as crypto, you're opening up yourself to a lot of scrutiny, a lot of questions. So boomers within the investment community will be asking you tough questions like, why are you investing in this? How are you investing in this? And how are you monitoring the space? And I'm sure these 13% of endowments that and foundations that have been investing in crypto are probably getting a lot of tough questions. What really blew my mind is that in Asia, 100% of financial advisors and 86% of high net worth individuals hold Bitcoin to a certain extent, or like buy and invest in digital assets, to be specific, to a certain extent, which is mind blowing. So essentially, all these financial advisors, they're like, were able to convince their clients in Asia to own crypto. I honestly don't have a valid answer or even a theory as to why there is such a gap between smaller retail investors in the United States versus investors in Asia.
This is a really interesting presentation on this. I think also what's also interesting is that you see in US, endowment and foundation has 13% buying digital assets, right? But in Asia, where you have financial advisors buying like 100% buying digital assets, you see endowment foundation at zero.
I think the endowments and foundations outside of US are probably a little more conservative.
Okay.
And for that reason, they have also not done as well as the endowments and foundations have done in the US, because the endowments and foundations in the United States have been heavily invested into venture capital. For the last 10 years, venture capital has done amazingly well. It's like all these big companies, like unicorns, the likes of Uber and Facebook, they all started out as these venture capital backed startups, right? And eventually they took off, and investors have made a lot of money on that. But who are the investors? Endowments like Yale universities and Harvard, Princeton, and so on. That's why they've done so well, and I think maybe that's the reason why they're a little more receptive to cryptocurrencies, because they look at it the same way. They're like, venture capital is very early stage, it's very risky, it's very innovative, and the same goes with crypto. Crypto is also early stage, very risky, very innovative. So we're going to invest, and we're going to lose some, we're going to win some.
With that said, I'm really curious to know your opinion on, since you're in a financial industry, right? Where do you see stock market along with crypto is headed for the remaining of the year?
It's really hard to make a bull case for the stock market and the financial markets in general for this year. Really hard. So I tend to lean towards saying that the stock market is going to finish, the equities market is going to finish the year down. And essentially, we're going to be down across all of the asset classes, because, and it's something that I didn't, probably a little too early, but you remember from our conversations, I've been calling this reversal in just these nosebleed valuations from like back in 2019, I think, back in 2020. It's just your interest rates are so low because of an extremely accommodative monetary policy by the central banks, not just the Federal Reserve, but central banks across the globe. All of a sudden, because you're able to borrow at such low costs, funding business projects, funding businesses in general, becomes extremely cheap. So
right.
your required return on investment all of a sudden doesn't need to be as high for you to fund all these different projects. And that's why investors no longer have to be as picky with the investments they make. They can make investments across the board and they're going to make money, because at the end of the day, their return on investment is still going to be slightly higher than the rate that they would be borrowing at, because of how low the rates are. And eventually, people are just going to keep piling in into these riskier assets. And this era of cheap money all of a sudden is coming to an end. And it's coming to an end pretty quickly, because the Federal Reserve has made it clear that we need to stop inflation at all costs. Is that going to slow down the economy? Probably, possibly, very likely. Do we care? Probably not, because we still need to stop the inflation. And my concern is, instead of stopping the inflation and slowing down the economy, we're essentially going to be stuck in a stagflation, where the economy slows down, but the inflation doesn't. Because from the monetary and the fiscal policy standpoint, it's really tough. It's really tough to get out of that situation, because you're essentially your monetary, like on the monetary side, your emission goes out, and it's like, what else can you really do to speed up the economy? All you can do is probably expand the fiscal policy, meaning the government spending has to go up, or you have to cut taxes. But then, how can you do that when your government is already operating under fiscal deficit? Your government is making less money from tax revenues than it's already spending. So essentially, you're kind of stuck in a vicious cycle where, to fund this government expenditures, you kind of have to print more money.
Yeah.
That money has to come from somewhere. And again, that contributes to inflation. So, but back to the original question, I think the equities are down. All the major asset classes are down. And maybe it's needed right now. We've been enjoying such a long and extended period of quick and easy returns. It's time for the markets to normalize a little bit. So I think it opens up a lot of opportunities for fundamental investors that research their stuff, that actually do extensive research on stocks or cryptocurrencies that they own. And I think those people are probably going to do better than people that just post the rocket emoji on Twitter.
You know what I find interesting? Remember when COVID happened, and then when Fed came out and said that they're going to support the economy no matter what, right? Then we saw this incredible spike in asset prices. Everything was going to the moon. And then people got so arrogant to the point where they started to dismiss legendary investors like Charlie Munger and Warren Buffett, right? Saying like, oh, those guys are too old. Like, I think I'm also guilty of that too, to some extent. Like, but mine was about crypto. But back to the thing, people just got so cocky with, like you said, right, with cheap money, with easy returns. Like, you put money anywhere, it goes up. That they start saying, oh, Warren Buffett is not buying anything. He doesn't know anything. He washed out. Like, one of his quotes that I think stuck with me for a long time is, markets can remain irrelevant longer than you can remain solvent, or something like this.
Yeah. So markets can stay irrational.
Irrational, yeah. And the fact that all this time he just waited, he would make buys, but they would be so tiny. And now when everything is bleeding, here he comes, just snatching up deals left and right. Again, goes back to the point, right? Like, sticking with fundamentals. It's the reason why he's got to where he is now over all these years. So a humble pie to us all. Except for you.
No, I definitely fall within the same camp. Yeah, definitely, you definitely start to doubt the person when they underperform for such a long time, and start thinking, oh yeah, like Warren Buffett is old, he's in his 90s, probably already lost his mojo, so maybe the guy's just too old. But then, yeah, right now it seems like the guy was right. And at the end of the day, it's a marathon, not a sprint. So yeah, he might have been wrong for like 3 years or 4 years or 5. He's the kind of guy that's been around for 65 years, and he's invested across different economic and capital cycles. So he probably knows it better than all of us. And in that sense, I'm appreciative of the fact that we were born early enough for us to see the legends while they're still alive.
Right.
Because I don't know how much longer they've got left. Like Warren Buffett and Charlie Munger, they're both like 95, I think, at this point.
Yeah.
They're in their mid 90s. Can I be the Jamie and look up the age?
Yeah, of course. 95 and drinking Coke.
Yeah.
Legend.
I have no idea how they get away with that. Yeah. So Charlie Munger is 98. He's almost 100 at this point.
Wow.
Warren Buffett is 91. So he's relatively younger, but he's still up there. So it's crazy. It's crazy. The Queen of England I think is turning 100 this year. But it's just crazy. These guys are still around. They're still kicking. And good for them. Good for them. And being able to witness that firsthand, not see them in person, but still kind of feel their presence in the media and in financial markets is definitely a privilege.
Mhm.
One thing that I regret is that I kind of wish that as a part of my job, I could at least once get to travel to Nebraska and actually see the Berkshire Hathaway annual shareholder conference, so that I could actually see them in those conferences live. Because they had one this year, last month, if I recall correctly, or sometime this month. And I was like, man, I wish I could go, because I don't know if they're still going to be around next year.
Mm-hmm.
You can never tell, especially at that age.
Is this type of event that you could go without your employer's permission? Say, is it possible for you to take that day off and then?
You could, but I think you have to be a shareholder to actually go.
Okay.
Yeah, I think you actually have to be a significant shareholder. I don't know how exclusive the event is, but I think there is a deal of exclusivity to these shareholder conferences, because at the end of the day, they're really famous investors, and if it was an open conference, I feel like it would just not be sustainable. I don't think they would be able to accommodate all these people from all over the world trying to fly in. But if anything, if I was the mayor of Omaha, Nebraska, so the city where the headquarters are, I would go to Warren Buffett's office and I would try to convince him to make it as open to everybody as possible. It's like, let all the retail investors in, let everybody in. We're gonna host it in a stadium if needed. Because imagine, like, if you're a mayor of a small town like that, Omaha, Nebraska, like, how small is it? It's like Omaha, Nebraska is a town with a population of 500,000 people, roughly speaking. So 500, if you're a town of 500,000 people in the middle of Nebraska, you probably want some tourists, right? Like, to juice up the economy a little bit. And man, that's your main tourist attraction. Do you know anything else about Omaha, Nebraska?
Yeah, and you can kind of leverage their ages too, right? Well, they're 98, 91. You guys might want to catch them.
Come while they're still alive.
Yeah.
You get to see the dinosaurs in person.
T-Rex. Yeah. Actually, that kind of brings us back to that previous point where, remember when you asked me the lessons about Luna? And one of those was like specialization over generalization, right? Again, with Warren Buffett, over time, there was internet, there was crypto. He still decided to stick with what he knew best. And in the long term, that has paid him off like 100x, even more at this point, probably. So.
Yeah, that's just money that he gained. You also have to consider the money that he didn't lose. Because in a market like this, what matters is how much money you do not lose.
I'm also curious to know, how much money did he lose to inflation while waiting all these years to snatch up deals?
That's a good question. I honestly don't know. I probably have to look at the returns and actually try to understand what was that cash drag. But over years, you definitely don't want to hold extensive balances of cash. Because that's just, it's almost like, I don't know, driving a car with like manual brake on. It's just gonna slow you down. It's just gonna be dragging you through across the road, trying to drive forward. I think opportunistically being able to deploy cash pretty quickly is great, but then you kind of have to be really good at timing the market, right? Because you could be sitting on cash for years and wait for the storm to happen, and the storm never happens.
Yeah, that's a good point.
Yeah. Because people were calling the drawdown even back in like 2015, 2016. They're like, oh my God, look at these valuations. They're so crazy. And to your point, the quote that you brought up, Warren Buffett's quote about markets staying irrational longer than they solvent. It's like some people probably held cash as early as 2015. They were waiting for this.
Yes. even the 2020 crash, remember? Like correction, let's just call it correction, not crash. I'm guilty of that too. When all these stocks were dropping like rock, you just kept thinking that, well, it's gonna go lower, I'll wait. Only to end up buying it higher.
Yeah. Well, who knows? Maybe we'll get another chance with the monkeypox coming out.
Yeah.
Monkeypox becomes a pandemic, maybe another crash, and we'll be able to buy some this time.
Yeah, but I really think this current market situation is really beneficial for long-term investors. If you have an outlook of 10, 20 years, right, you don't really care what happens this year. If things drop, you keep buying. If things go up, well, you either hold or you buy whenever you see price drop. It's kind of a good thing that in this market you get rid of the short-term traders that
100%.
Yeah, that buy and sell. And especially there are a lot of them these days, given that investing has become so easy through these stock market apps, right? Like there were so many of those apps that just launched recently, like in the middle of the COVID, like in 2020. That's a good thing, yeah.
Yeah, with the rise of retail investors, which I guess makes me wonder: is there just a mind shift across the general population in their approach towards investments, or is this more just retail investors being rewarded for being holders in this bullish market the last 10 years? So the question that I'm trying to ask is, the diamond hands phrase, I think is indicative of this long-term holder mentality that a lot of retail investors are trying to adopt. But it's really easy to be diamond hands when the markets are going up and up, right?
Yeah.
Like, oh yeah, it's easy. Yeah, I mean, obviously you definitely have those temptations to sell when the markets keep going up, and you're like, man, I want to get some money off the table. Like, I actually want to take the cash, buy some stuff. But then, can this mentality persist if we go into a recession, if this bear market that we're currently seeing persists? Because I'm comparing this to the crash of 1929 and the subsequent Great Depression. So what happened historically, coming out of that depression, the Great Generation, the people that lived through that era, they were also active investors. They all had brokers, like middle-class Americans, maybe even working-class Americans, all had brokers on Wall Street that they were trading with, they were buying stocks, they were selling stocks. But after the crash and after the Great Depression, people became really scarred by the stock market, and they became ultra-conservative when it comes to their investments. So all these mutual funds that came out of the financial system that emerged in like 1940s and 1950s, 1960s, in the subsequent decades, I think for decades, essentially the asset management industry was dominated by super conservative funds. mutual funds that they were like, oh, we're just gonna invest in like utility companies. We're gonna invest in these like super stable industrial companies that will never go out of business and will never lose money. And this risk on in like sentiment only became a thing recently. So now with stocks going up, technology, new technologies being invented, it's the retail investors now are becoming more daring, and it makes me wonder, like, is that gonna persist after this bear market, or are people gonna become like they were population was back in 1940s?
I have a little bit different opinion on this, but I think that actually people are a lot more impatient today with the rise of like social media, of rise of technologies, right? The time spent for majority of retail investors is super short. Like for them to hold on to a stock could probably mean a month or 2 months, max 6 months, right? And you're always in this dopamine induced mania where you want quick returns, and if you don't get it, you dip. Maybe we'll see a lot of those retail investors leave market sooner rather than later, which again, if we end up being in a depression like environment, I think at that point many of us will have to reassess, right, the positions that we hold and whether they have the potential, kind of reallocate the remaining capital we have. But even then, I think it would still be a good opportunity for long-term investors to keep buying.
That's a good point, and I think so. I'm trying to think about this. I think you raise an excellent point. So, in an era where if I want to buy a chair, I can go on Amazon Prime and it's going to arrive tomorrow.
Exactly.
Boom, right here. If I want to go get laid, it's like I can swipe 20 times and boom, Tinder.
Instant gratification, yeah.
Instant gratification, Instagram, on social media,
Reddit, yeah.
Validation you need, everything. So, in an era of extreme convenience, it's hard to stay patient in an industry as inconvenient as financial markets, where you can buy a stock and you're like, oh, go to the moon. Come on. Like, I'm waiting. Why is this not 100x? Tired. You make a good point. You actually make a great point. And I think because of all this volatility in the markets, the instant gratification actually came to the financial markets as well. People would make money a lot faster, and the prices would swing up and down a lot faster. People could take advantage of that.
Right. Even like all these Reddit posts that you see, what's that? Wall Street Bets, right? Another one. Nothing against the forum, but a lot of people that join those forums, their time frame is anywhere between 3 to 6 months, and they will jump on anything that promises either an overnight return on money or something that return on money that will happen rather quickly. So, long silver because this institution has been suppressing the price, or it is projected to go up in the next 3 weeks or something, and you end up opening your position. But when it doesn't happen, you don't have the patience to continue holding it because you also don't understand the industry. You don't understand the company. And what you end up doing when that promise never arrives, you end up leaving the market, or you end up trying something different. And as you continue in this cycle, you just end up losing your money to the point when eventually you just quit the market altogether. And I think we're kind of in a similar situation. It would really be a good thing to get rid of those investors like this, because they are also guilty of creating this volatility in some sense. And also the social media platforms like YouTube, although most of those investing channels, like they don't make situation any better either, except for like other ones that have been in the market for a while. For example, Stefan Graham, right? I'm sure you know the guy. His investing strategy is super old school. He's very old tradition, right? Like in terms of his investing strategy. He buys, things go down, he doesn't care. He's been in the market for like 15 years or something at this point. And his stock market portfolio has outperformed most of these other YouTubers who have been jumping around the trends and doing all sorts of things, leverage and in and out sort of investing. So again, goes to show that, especially in the stock market, you really need to have like you said, right? You need to have the patience to ignore the noise and continue buying if the company is good, and regardless of the environment. Unless war happens, then sorry, buddy. Money won't matter at that point anyway.
Yeah. Well, it's fun historical fact on the topic of wars and stock markets. I think the way the Rothschild family made a big fortune in the 19th or maybe even 18th century is... Oh, no, I think that might have been 19th century, and please do fact check me on this. I think it was the Battle of Waterloo. So the Battle of Waterloo was it's like a famous battle that happened in 1815, and I think back then, obviously, the news didn't spread as fast as to the outcomes of battles, and I think basically what happened was one of the sides lost the battle, and might have been either the Dutch stock market or the British stock market. People got the fake news that their side of the battle lost, and they started dumping the stocks massively, even though their side actually won. I forgot if it was the French or the Dutch or the British that got the sides, but I just remember that the side that thought that they lost started dumping their stocks massively because they thought, oh, we lost the war. It's going to be important.
Wow.
And the Rothschilds were buying up the stock because they actually got the right news that the battle was actually won. And they made some big money because they bought the dip. They were the original diamond hands.
How much do you think they contributed to that misinformation? Or do you think at the time they were not as powerful to actually have any influence on it?
They could potentially, probably. But what I can tell you is that I think their source of information was reliable, and they essentially decided not to share it with anybody. Just quietly kept buying the stuff that everybody was selling. They're like, yeah, well, no, the battle actually turned out fine, but we're just going to keep buying it. So
wow.
I don't give a fuck. Yeah, it's a Black Friday. I'm just going to keep buying the Jordans.
Well, good for them, man.
Yeah. So maybe time to close out the stock topic, or the markets topic, and bring up if that's okay with you. So bring up the segment, the dumb question of the day segment.
Go ahead.
And
let's go.
My dumb question of the day is it mathematically possible to cut a cake into 3 pieces and make the 3 pieces perfectly equal to each other? Or is it physically possible to do that?
I think it is possible, but also people who are on the receiving end, right? Say if it's split on 3 and there's one person on each of those 3 pieces, well, everyone will view as if they have less than the other guy.
Well, yeah, no, not even the psychology part. I'm talking about the mathematical part. Because if you divide 1 by 3, what's the result? It's 0.333333 into infinity, right?
Yeah.
So how can you cut the cake in 3 pieces for the cake to be a whole, still be 1, and everybody have that infinite 33333 at the end?
I get your question, but Bratan, man, I am not the person to have any input in this, because I am so terrible in math. I should not even comment on this, man. But I really have no idea. I think you just then basically you don't go with the precision in terms of the percentage of the pie, but you go with the estimate. So,
or to make it mathematically accurate, you know what needs to happen? So 0.33% has to go to one person, another 0.33% has to go, 33%, so 33.3% has to go to one person, another 33.3% has to go to another, and then remaining 33%, 1.3 has to go to the third person, and then at least 0.01%, right?
Yeah.
That's just gonna leave on the just leave it on the knife.
Actually, I just thought about it. That could be one way. Another way, you know what you could do? Before you cut anything, you could weigh the whole cake. Right? Say you get 6 pounds of the whole cake. And then you divide it to 3 pieces. And then when you cut it, you try to get as close to that 2 pounds, right?
So instead of defining it in percentage terms, you define it in actual weight terms.
Yeah.
And that way, everybody has 33.3333%, and it just keeps going into infinity.
Yeah.
So that means people get infinite cake.
That means they get infinite cavities.
I guess that's a good segue, man. That's a good segue into the next podcast. I think we gotta talk about sugar. Definitely.
About sugar? Yeah, we definitely need to.
Yeah, this needs to be an intervention session for my addiction, because I have a serious problem.
Nah, I think you're good. You're not. You don't have addiction, bro. It's not as bad as you think. You do? Really?
Yes. I tried to quit sugar 2 weeks ago. I couldn't.
Well, how did you go about it?
Like you told me, basically just have one day a week where it's like a cheat meal day. And then remaining days, actually don't eat any sugar. And then my cheat meal day turned into a cheat meal 2 days, and then cheat meal 3 days. I'm like, man, I just keep having these cheat meal days every day.
No, just have a cheat, not cheat meal, but cheat day. Say it's Saturday, just have the whole day that dedicated to eating all the sugars you want. But have you tried using like a healthy substitutes for sugar on your non-cheating days? No. No, not bananas. Like alternatives to sugar, like stevia. Because you need something that will give your brain something that is close to sugar, but it's not really sugar.
Yeah, bananas. Apples.
I mean, if you go with that, no, but like there's probably like almost no sugar in banana. Like you might be better off with honey, with stevia, truvia. What else? Like other fruits like strawberries that have some sugar content. Not sugar, but fructose content. Yeah, because you need to keep your brain sane. Because if you cut out the sugar altogether right away, it's going to be really difficult.
The brain is going to just start glitching.
Yeah, you will then go on this rampage like you did, right? Where your one cheat meal turned into 3-day binge eating on all the sugar. So,
sure.
Yeah, but I just take it like really, really slow. And yeah, if you want to say a soda, right? You just get diet drinks instead of the regular ones. And then when you crave sugar, you can get honey, which is good for you, which is a natural sugar. You get that. You could get the stevia. You could get other fruits, and that way you will keep your brain satiated with some form of a sugar content. And over time, you will then slowly get rid of the desire for sugar.
Okay, Sadhguru.
Essentially.
Hey, don't get us canceled. Cut that out. Democracy.
Oh, by the way, did you know that's not him? I had no idea.
Basically, government by the people, of the people, for the people. But the people are retarded.
All this time I thought it was really said by Sadhguru, right? because when I was reading his book, like it sounded nothing like him, right? I was like, what? It's interesting. Oh, he probably just grew mature over time. And I realized it's some Osho guy, man. It's not even some, but they look alike. Man, that's so bad, man. Getting back to the podcast, I think this one was really good, but I really enjoyed this one. This was a thorough conversation about a really serious topic, and
Yes.
the way we kind of got to bounce off the different points and questions and just help us navigate through the space also was very good experience.
You froze, bro. Oh, okay.
Yeah. you froze, bro.
I think it's also just one snapshot in time.
Yeah.
And the markets are such a moving thing that we should probably occasionally touch on this, continue just engaging on it's like as things progress. Talk more about crypto, talk more about stocks. And in terms of the teasers for the next episode, what do we got?
I'm sure something will come up, but I think for next one, let's try to discuss sugar, just overall health in general. And then along with that, we could probably throw in some MMA question or something.
Yeah, that's a good point. Or a sport, they talk about sports and doing sports recreational.
Or we could ask a question, or we could have a topic about why can Joe Rogan not be replaced?
Well, I mean, isn't that what we're trying to do here?
No, we're not trying to replace him, man. We're fans of Joe Rogan, man.
Yeah.
But back to the thing. But I think with today's podcast, getting your opinion on the markets is extremely invaluable, not just to me, but also to a lot of people that will end up listening to this podcast, especially coming with your background in the financial industry, and also the way that how level-headed your investment strategy is. I think it's something that the space has been deprived of, especially in like social media age on YouTube. So thank you for sharing insights, your opinion, because those were really all good points made by you.
Thank you. And thank you for explaining to me and the audience how hypothetically set up a cryptocurrency.
And pumping Charles. But yeah, I hope listeners enjoyed this one. That's a wrap for today. Thank you, Nachtjedaan.
Nachtjedaan.
Assalamu alaikum, Nachtjedaan. We'll talk next week.
Until next week.